Hey everyone, it's Imran from Options Insight with your macro options spotlight for today. And it's a big one. All eyes are going to be on the CPI today. It's the moment the market has been waiting for. Now, before we jump in, if you like these videos, you like this type of content, please like and subscribe to the channel. That will really help us with the algorithm and get more people to see this type of options related content, and it will really help us grow. Moving on. Looking at this market, it was quite bullish yesterday. S&P putting in a 1.4% rally, kind of recovering from that sell-off that we had post PPI on Friday, as markets prepare for what they think is going to come out today with regards to CPI. It's coming out in 15-20 minutes. And the S&P trading back towards that 4,000 area, which we said was a big strike for the Friday OPEX. That's where there's quite a lot of open interest. The VIX was also higher on the day, which is generally rare for markets to be up and VIX to be up at the same time. So clearly, there's a bid for gamma, there's a bid for volatility as people are expecting some movement today. We do expect a vicious reset in volatility, though, after the events pass. I don't think you'll get the whole reset after CPI, but certainly after FOMC, you would expect to see vol coming in as the market starts to price in the holiday period. Crude oil bouncing decently yesterday. Some news there of the Keystone pipeline, which is that needs repairs. Those repairs might be delayed, and that might create a bit of a shortage at Cushing, Oklahoma. So that's why crude was up about 2.5%. We saw natural gas rallying as well. Off the highs, opened up like 10% and then faded, but still finishing up 3% on the day, and uranium up as well. So all those, the energy sector kind of coming back to life a little bit, and you can see the metals actually drifting back down. So there seems to be a bit of negative correlation right now between what energy does and what metals do in the commodities complex. Now that may well be addressed today, where everything goes in the same direction depending on what CPI does. But I have been noticing lately, on days where metals are quite buoyant, energy is lagging, and vice versa. If we look at vols, like I said, vols did catch a bid along with VIX higher, and that was a decent move up in vols there. Spot rallying, and then to see one month implied vol, up 2.5 vols on the day in S&P. That's a pretty big move. These type of spot up, vol up moves, they don't happen very often, like I said, and usually they're a fade in terms of volatility, right? So you would expect implied volatility to really start to get hit again once we figure out what the CPI move will be. Commodity moves, commodity vols also up on the day. As you know, this type of data point is likely to move all assets, and they're pricing that in to some extent. Seeing a bit of a sea of green across carry, where you can see European carry still the highest in the 60%, but you're also seeing green now across the board in terms of equity indices. So a fair amount of implied vol premium as implied vols catch a bid, whereas the market's still not having its big move yet. So the realized volatility that is backward looking won't show that yet. So that sea of green is likely to change if we do get a big gap on CPI to be more in line, right? So I wouldn't read too much into that sea of green right now to then go out and smash a load of gamma out the door. It'd be a bit dangerous. But we do think with this much implied vol premium, if markets don't move significantly more than 3%, then vols will get hit hard into the weekend. So that's something to be careful of. You don't want to get caught too long vol at this point. And then skew also catching a bit of a bid across the board. Alongside vols, as vols go up, skew's going up as well. So people pricing in a bit more downside tail risk in equities. GDX, that's the gold miner index, that also seeing a decent bid to downside as well on the week, reversing the move. It was down on the week, it's now flipped to up. And when I say on the week, I mean last 5 trading days. And then uranium and oil put skew also catching a bit of a bid higher by half a vol to a vol as spots trade higher across energy, but clearly some demand for protection coming in alongside that. Okay, moving on. All eyes are going to be on the CPI. So what's going on? It's at 8:30, obviously, that's in 10 minutes. The key number to watch is going to be the month-on-month core, which is expected to be up 0.3%. Now, Powell has also stated that core services ex-shelter is an important one to keep an eye on because they do understand the lag effects to rent prices, to shelter prices. So that's going to be a key part of the data set to be aware of. Now, the S&P is currently pricing in a 2.5% move which if we look at previous CPI days, and you can see this chart here from Saxo, where it looks back at CPI and PCE releases going back to July, very big candles on all of these, right? So the fact that we're pricing at 2% is actually quite a low move relative to past candles that we have seen for these type of data releases, right? So maybe it's looking a bit cheap. Now the market might be assuming that whatever move we get on the CPI, if it is a big move, gets somewhat stalled by the fact that FOMC is coming out the very next day, and the Fed's reaction to a big move in markets may be to counter that with some words, right? So if the market dumps too hard, they might counter it with some softening words. If the market rallies too hard, they might counter it with some more hawkish words out of Powell. So that might be why the move is not implied to be so huge. And then the magnitude of today's move will be largely determined by how much zero DTE activity is triggered by the print. So we have been seeing, when we get these big data prints, you get a knee-jerk move, but then you also get a load of one-day options activity come in, and that then exacerbates the move as dealers get forced to hedge that. And then that hedging, because there's a lot of gamma against those options, that hedging kind of feeds on itself and accelerates the move in markets, right? So that's something we need to be aware of, and we need to keep an eye on if there's any big one-day option flows that come in post the numbers. Okay, so that's CPI and what to kind of expect. In terms of trades, we've been talking about a few trades over the last week or two setting up for this event, right? So we said on the upside, we think NASDAQ has the potential to rally quite hard if this number does miss. And then on the downside, if the number is higher than expected, we think the dollar hasn't really moved enough, right? The dollar didn't really rally, so there is room for euro to get sold, dollar to rally, that type of thing. And the volatility has been coming down on euro, so maybe there's some opportunity there. So those are kind of where the asymmetry kind of lies. Another trade that we flagged was just a gamma spread, where you sell DAX gamma and you buy NASDAQ gamma, but you could also do S&P gamma. So we're just looking at the implied vol levels between S&P and DAX, and we can see that on the downside strikes that we had suggested last week with the NASDAQ trade, you can get into that spread. If you do 1 month 95% puts, right, you can get into that spread at around 2.5 vols. So you're paying 2.5 vols more for the S&P vol than what you're selling for the DAX vol. But the realized volatility at the moment between those two is 15 vols. So that means the S&P 10-day realized is 15 vols above the DAX. So clearly the S&P is winging around like a madman relative to the DAX. And the chances are on the US inflation print, the S&P is going to react more than the DAX will. And again, on the FOMC tomorrow, you would again expect the S&P to probably react more to what Powell's going to say than the DAX. So I would have thought for the next couple of days, that gamma spread, getting into that gamma spread at 2.5 vols seems like an okay place to be with that type of realized historically, and also the potential for more realized to come on these key data prints. So that's one trade that we've talked about. And then another thing we're looking at is gold. So gold has obviously rallied, but since late November, a few weeks ago, we've had a stellar performance out of silver and copper. So silver's up 12%, copper's up 6%, and gold's only up 3%. So why is it lagging? Well, those other metals obviously got a bit of a tailwind from the China reopen story. So we think that has helped drive that. But gold is just getting stuck at this key resistance point, right? So 1810 seems to be a hurdle that gold is struggling to break. If it manages to break it today on the CPI, then we may well ratchet up to the next area of resistance, which is going to be up here, through 1850. But if we find that 1810 area is providing too much resistance for gold to break, and then we do think there's an opportunity to play a rejection of that resistance, basically. So I wouldn't execute a trade here right now. I'd wait to see what happens with CPI, see if we get a rally, see if we can't break 1810, and if that gets rejected, then you can maybe put some trades on to fade that rally. And the way I would fade that rally was probably through put spreads. So no specific trade, but if we look at the dashboard on gold, good luck out there. You may need to be pretty nimble to trade around this number. I don't think we're going to get a 5-6% move necessarily like we got last month, but a 2 to 3% rally here looks feasible if the CPI is a miss. And on the downside, there's a fair amount of bearishness still out there. So I wouldn't be surprised if the market knee jerks lower and then finds some support similar to some of the moves that we got last week. All right, that's it from me, and I'll catch you guys tomorrow.